You're listening to the Financial Sense.
Going to be an issue, I think, in my opinion, for the balance of this decade. Let's find out what all this means. Joining me on the program from Bianco Research is Jim Bianco. Jim, we're just, 68 billion away from 37 trillion. We'll probably add another trillion on top of that this year. So let's talk about the debt, because we're seeing more and more articles on it, whether it's the bond market, Jamie Dimon commenting on it, or Elon Musk.
Yeah, first of all, you got to get your terminology right. We're a quarter of a Musk away from 37 trillion on the debt right now. The thing about the debt is there's two things about it. It is a real problem. Let's talk about what it really means. The federal government's budget is about $7 trillion. That's about 23% of GDP. Taxes raise 5. We have to borrow the other 2-ish. It's probably, depending, that's what it is now. And then we've got this big, beautiful bill making its way through Congress. Who knows what it's going to be next year? But most likely it's going to be a bigger spending bill and a bigger deficit. Those are real problems for the U.S. economy in one respect. In one respect, it's a boost to the economy because the government takes in this money. It spends this money. It spends the money inefficiently. But it does produce GDP, but it also can produce inflation. The other problem is that $2 trillion that it has to borrow. There's an old line in the bond market that there are no bad bonds, there's only bad prices. Can the government continue to raise $2 trillion to fund itself? Sure, it can, seriously, for the end of time. It's just you might not like the interest rate that it would have to do to clear $2 trillion worth of debt. And that interest rate will then become a hurdle for all other investments, especially real estate with cap prices, valuations in the stock market, all the way on down, borrowing costs, whether it's a mortgage or to fund a business, because the government's interest rate that it has to clear that $2 trillion that it has to borrow is going to be so high. So there are no bad bonds. There's only bad prices. And that's the bigger concern right now, is that all of that borrowing is going to continue to push interest rates up. Now, one last nuance I would give you on this. I've been arguing that a 5% 30-year yield, and we're exactly there right now as we're talking, is not a very high level. That is a fairly normal level. That is really, all things being equal, what we should expect it to be at. Given the uptick in inflation, the uncertainty, the premiums that you have to build into it, it should be about 5%. So what am I trying to say? A lot of people are looking at 5% yields and going, this is the budget deficit. This is the big, beautiful bill, extracting its toll on the bond market. I don't think it is. I think that's to come. I think the fear is that if the big, beautiful bill is big spending, big deficits, it will then cause interest rates to go even higher than the levels we are now. In other words, it is not reflecting, the bond market is not reflecting the potential damage that this bill could do to it. That's to come. And the reason it doesn't reflect it now is because the Senate hasn't passed it. It hasn't gone through reconciliation. There's some hope that maybe this will change before we get to the final version of it and not be as bond negative. But right now, I don't think it's really reflecting any of the downsides on it.
I think COVID shutting down the stimulus, the checks they sent out, and then also the big bills that came out of the Biden administration. I mean, we literally blew the debt out of the water in the last 3 or 4 years. I've never seen that kind of fiscal spending.
Yeah, no, you're exactly right. As I said, $7 trillion, about 23% of the GDP of the country is the government spending on its bill, on its budget of $7 trillion. Put that number in perspective. There's only been 5 times in history that it's been larger than this number, 23%. In order, that's the Civil War, World War I, World War II, the financial crisis, and the COVID response. In other words, the only other times the government has spent this level of money has been a major crisis, like the global financial crisis or the COVID response, or a major war. And so as far as a non-crisis peacetime amount of money, this is the highest, the most the government has ever spent. As a matter of fact, if you look back the last 50 years, we have a Keynesian response to government spending, meaning when the economy slows, We see more government spending to try and stimulate it out of a recession. Right now, we're spending more than most of the peak spending in terms of a percent of GDP that we saw in the 80s, 90s, and 2000s in the middle of a recession. When the Congress passed a bill saying we're panicking, throw money at the economy to get it to stimulate it out of recession, we're spending more as a percent of GDP today without a recession, without a financial crisis, without any kind of crisis than we did when we were in crisis 20 or 30 years ago. So this is completely unprecedented, the level of spending that we're having right now.
And that brings up the question, since probably 2022, we've been on again, off again. We're going to be in a recession. No, we're not in a recession. We keep going back and forth. Imagine if we were to go into recession, if we're at 2 trillion in deficits now, you go into recession, we could be at 3.5, even more, go up to 10 to 12% of GDP.
That's exactly the fear. And and the fear is again, there are no bad bonds, there's only bad prices. The government will get its $3 trillion. It will take interest rates up, suffocate all other investment and other opportunities in order to fund itself at exactly the time you don't want that to happen. When the economy is slowing, unemployment is rising, you don't want to see interest rates go up, but that's the risk that we face right now. And as far as your bigger picture question, a recession. What is a recession? I've said this on this channel with you before. The natural state of an economy, a capitalist economy, and yeah, we're a capitalist economy. I know we like to make fun of it, but we are, is to grow. Now, 90% of the years since World War II have been expansion years. Sometimes they're slow, sometimes they're fast, but we grow. 10% of the years have been recessions. So what is a recession? Well, there was an economist in the 1970s at MIT, Rudy Dornbush, and he coined a famous line among the economic community: recessions, economic expansions don't die of old age. They're murdered. And what does he mean by that? Well, as I like to jokingly say, the last most unqualified person to tell you we're going to have a recession is an economist, and I don't mean that to slight economists, is that the economy's growing. People are spending. Everything's going, like I said, it could be slow, it could be fast. An economist can tell you whether or not it's going to be slow or fast. Something happens, a COVID shutdown, a war, a terrorist attack like 9/11. People's behavior instantly changes. They stop doing economic activity and the economy contracts. Typically, that's why I said an economist can't see that in the CPI data or the employment data that, that there's a terrorist attack coming next week, thinking about 9/11, and that's going to cause everybody to change their behavior and a contraction in the economy. Other people, political analysts and stuff like that, could see that happening as well. So what's been happening over the last couple of years is we've had a series of events sticking with this, that the economy's murdered, that you could think were murder weapons. The first one in 22 was interest rates. The Fed raised rates from 0 to 4% a year, and interest rates soared. Was that a murder weapon? Well, it's a reasonable argument that it could have been, but it wasn't. 23, Silicon Valley Bank failed. A bunch of other banks like Republic and Credit Suisse all failed around the same time. Maybe we're going to have a financial crisis because of all these bank failures. Is that going to be a murder weapon? Reasonable argument. It turned out not to be one. April, we had a 20% correction in the stock market, Liberation Day, with all the tariffs, and everybody was looking at that. This is going to change people's behavior, and that is going to cause a recession. Reasonable argument to be made, but what we're learning is it didn't happen. So the day we're recording, the JOLTS report, job openings, labor market, came out. Now, if you're old enough, you'll remember this is like the old newspaper wanted ads index, but we don't use newspaper wanted ads anymore. So they have the JOLTS report, which measures the total amount of jobs that American businesses are advertising to fill. In March, it was 7.1 million jobs. In April, it was 7.39 million, 290,000 more jobs in April. Now, why is that important? In and of itself, that's not a remarkable number, go from 7.1 to 7.39. But that was the month the stock market fell 20%, that everybody told me that the soft data was collapsing, that meant we were going to have a recession, and that, the tariffs were going to cause the store shelves to be empty within 4 or 5 weeks. That was in early April that we were saying that. None of that happened. And what were businesses doing during that period? they were actually filling out forms on job hiring websites to increase the amount of people that they're looking to hire. Now they haven't hired them yet, but they increased the amount of advertising for them. In other words, they weren't acting like there was a contraction in the economy that they needed to, change because everybody stopped doing economic activity. So it was a reasonable argument to be made that that could have been a recession. But that's why since 22, we've been off again, on again, arguing about recession because we have high interest rates, bank failures, then we have this tariff thing, and everybody wonders, is that the thing that's going to get people to say, that's it, we're not going to buy the house, forget about getting a new car, we have to cut back on the budget, we can't spend as much money, those kind of things. No, that didn't happen. So the economy just continues to motor along.
Yeah, going back to that saying, the natural inclination for the economy in a capitalist society is to grow, unless you get, as you talk about, an exogenous shock. Is it surprised you, given these shocks, the jump in interest rates, the Silicon Valley Bank, the Liberation Day, none of these have had the impact on the economy that many economists might say, oh, okay, this is it. This will do it. Like you said, in April, people were talking about all this happening. Will probably, I remember hearing recession talk.
Yeah, you're right. It's somewhat surprising. It's like I said, it's always hard to figure out what is going to be that murder that actually gets people to change their activity. Remember, the last recession was obvious in hindsight, right? We shut down the global economy. We sent everybody home and told them they could not do by law economic activity. So we had a recession in 2020. The one before that was the global financial crisis. That was what, changed everybody's behavior. So those were really big events. You could have argued that some of these had the potential, like I said, the rise in interest rates, Silicon Valley Bank, or the Liberation Day announcement, but they didn't really, kick off. Now, in fairness, maybe I'm a little early on this, check back in September to December, maybe then it will become obvious that things did people altered their behavior. I don't think so, but that's always possible. But yeah, it is surprising. But I would also say too, that there was a consequence to this, all of this activity. And that consequence has been inflation. And that we have had a persistent inflation problem since 2020. Now, a lot of people say, when I say there's a persistent inflation problem, they'll say, what are you talking about? We're at a 4-year low in inflation as of April, the latest data that we have. Yes, and I'm going to use core inflation as my metric. You could argue correctly it's at a 4-year low. But that level that we're at, 2.8% core CPI, is higher than any level we had between 2010 and 2022. All the way up to when the Fed started raising rates. So during that big disinflationary period of the 2010s, we never had, if we ever had a level that was 2.8%, we never got that high. We would have thought that it was wholly unacceptable to see inflation that high. Today, we're celebrating that we fell to 2.8%. The point is, this is a high level for inflation, even at 2.8. I have some arguments to be made that the inflation level might be bottoming here this summer and turning up before the end of the year, and we might get back over 3%. Tariff-driven inflation and some other factors could push it up. But yeah, at this point, if there is a consequence to everything we've seen, it very well could be that it keeps that inflation impulse going. And that's one of the reasons, like I said, maybe a 5% 30-year Treasury yield is not, something that we should all walk around and go, what's wrong with the bond market? Why are yields so high? It must be the big, beautiful bill or something. No, it might be that that's just naturally where they should be. And the big, beautiful bill could be problematic for bonds, but that means even higher rates from here.
Yeah, because they're hoping to get this bill passed by the end of June. And I think Trump knows that he's got about a year to fix or do the things he wants to do, because Jim, next year it's all about the midterm elections. And I can't imagine the administration would want to be in a recession, a bear market, or a risk actually to Trump, high rates of inflation, because inflation was an issue in the 2024 election.
Yeah, I think, there's two things there about it. One economic and the other political. The economic one is you mentioned about the $37 trillion of debt. Don't forget that we hit the debt ceiling and that we cannot increase the amount of debt until we raise the debt ceiling. Now, the government is doing a series of what they call extraordinary measures. They can they can't add new debt, but what they can do is borrow against some assets. So there's millions of federal government employees. They've got hundreds of billions of dollars in their collective pension plans with the federal government. The government is borrowing money, collateralizing it by against those pension plans. As I've always said, if a private corporation did that, look, we're going to borrow money to expand our business and we're going to collateralize it against all our employees' pension plans, everybody goes to jail, but not when you're the government. Then it's smart financial assets. So they do that. They have a thing called the Treasury General Account. It's like the checking account that they pay all the government's bills out of. There's still about $400 billion in that account. They can run that down to zero too. Then when they've used up all these extraordinary means and run down that account to zero, that's referred to as the X date. That is the date at which, at that point, the government then risks technical default. Why? Because the next Treasury security that comes due, if it's a $50 billion Treasury bill that matures the next day, where do they get the $50 billion to pay those Treasury bill holders? They have to issue another $50 billion Treasury bill. Well, if they can't do that, they can't pay the old one, and we go into technical default. That's the X date. That is perceived to be somewhere in the month of August. So Trump is saying he wants to get this bill wrapped up by the end of June for two reasons. One, give himself a little bit of a fudge factor before we get to the August period where we hit the X date, because the bill will also include a raising of the debt ceiling. Two, the first half of July is shot anyway because Congress goes on recess for the 4th of July, so they're not going to be around for 2 weeks. And so that then they get back on the 15th, and then that really pressures them even harder to try and get this bill passed. So they got to get this thing passed by then. And then the other one is a political one. And I'll get a little political because it's all public statements. The Democrats have already said, if they retake the House, the first bill they're going to do is going to be to impeach Donald Trump again. Now, will it go anywhere? No, probably not, because they will never have 66 votes to convict him in the Senate. But the point is, if they retake the House, his agenda's done, as you pointed out. There will be nothing done on his agenda passed. So he's got a window of opportunity now. He has to push as hard as he can now to get as much of it as he can get. Hope that it is viewed positively and that the Republicans hold the House and the Senate through the midterms and give him another 2 years to extend his agenda. Otherwise, it effectively will be over with, after the November 2026 elections.
Assuming that we don't get a big jump in inflation next year, but let's assume the economy's growing, people got jobs, and the stock market's up, what would the Democrats run on politically against Trump if those things were in place next November of 26?
Well, they're hoping that they won't be. But, if those things are in place, then they'll probably have to run on some cultural issue or some other lesser economic issue. Maybe they run on, some unfairness that they perceive or foreign policy or something like that. The problem with all of those other issues is those are not top of mind when voters go to the ballot box. Remember, in 24, the polls, the political polls asked, what's the top thing you're voting on? And overwhelmingly, the public said inflation. And the Biden administration was correct to point out, but it was 9% in 2022. And here we are in the middle of 24, and it's down around 3. So it's went from 9 to 3. If you're running on inflation, you got to vote us in because it went from 9 to 3. We've done a very good job of bringing it down. And voters said, no, we're still hurting over the cumulative increase over the last 4 years. So the point is, yeah, they could try and run on, foreign policy issues or cultural issues or something like that. But the American public votes on economic issues. And if they don't have the Democrats, to put it from the Democrats' perspective, if they don't have a bear market, loss of jobs, a recession, or some other type of economic stress point that they could point to, yeah, it'll be very hard for them to run on something in in a year and a half. But history shows, there's almost going to always be something that'll be an economic stress point. Who knows what it'll be or how it'll unfold, but it wouldn't shock me if there is something by the time we get to November 2026.
Now let's talk about the goodies in the tax bill. So one of the things he wants to eliminate taxation of Social Security. Jim, when I got in the business, people forget you used to not pay taxes on Social Security. So that's going to be a big hit with the senior crowd, eliminating taxes there. He's also talking about eliminating taxes on tips and overtime. That has got to be popular. So, that in itself is going to create some stimulus in itself right there. So I can't imagine people being upset that they don't have to pay taxes on Social Security or tips and overtime.
Right. And he's also talking about raising taxes, at least floated the idea, raising taxes on people over $2.5 million and raising taxes on remittances from foreign governments or foreign countries into the United States. So there are some tax increases in there. And it reminds me of that famous line from Grover Norquist, who ran the Tax Foundation. He said, if Republicans don't cut taxes, what is the point of having a Republican Party in the first place? And so they're kind of leaning towards that idea of there are some tax increases that we might want to visit as well too. So there's a lot of goodies in there. And again, the House passed a version of the bill. The Senate will pass a different version of the bill with different priorities. Then it goes to a conference where they have to come up with the exact same bill, repass it on both the House and the Senate, and then send it to the president to sign. So this is a working process. It's hardly, when we talk about, no tax on tips and stuff like that, that's the House version. We'll see if it survives all the way to the point where Trump gets to sign it, if it's still there.
I want to talk about, let's say they pass this bill. It's going to be a lot more spending. What are the chances that at some way the bond market would respond and we have a Liz Truss moment?
I think it's very high. I think, the Liz Truss moment for all of those, in 2022, she was the prime minister in the UK. They then floated a bill that was going to cut taxes, increase spending, blow out the deficit. And their parliament was all set to vote on it, except they had one small problem. Their bond market hated it and blew up, and interest rates soared, created chaos. Liz Truss was kicked out after 47 days, excuse me. She didn't remember the famous meme, she didn't last as long as a head of lettuce. So that was the bond market vigilantes imposing some discipline on the biggest borrower of debt, the government in the UK. I think there's a very high chance that you're going to see something like that in the United States. That the bond market will impose discipline on the federal government. You want to do this, you want to do that, you want to spend, borrow. Well, as I said, you're not going to like the interest rate you're going to have to do it at, and we're going to punish with these interest rates unless you cut back. Now, I do believe that's going to happen. When? Is it going to be later this year? Is it going to be in 10 years? Somewhere in between? That's the open question. Now, the reason I think that's going to be is, when is Congress ever going to get disciplined to say, as much as we like these ideas, there are priorities and there are limitations to what we could do. And we have to make some hard choices that we could do certain things, but not other things, because we don't have the resources to do everything. Up until now, they've been pretty much told they have the resources to do whatever they want. And they do whatever they want. And, whether it's Janet Yellen issuing more bills and less notes, or the Federal Reserve doing quantitative easing to lower interest rates to accommodate them doing whatever they want. So they think that's the way things work. They're never going to show up one day and say, we could do whatever we want, but now we can't. So we have to be serious about making choices. They won't. They'll keep going. And the only person that will stop them will be the bond market. The only question is when. I don't have an idea of when, but I do remember, from The Sun Also Rises, Ernest Hemingway, how does one go bankrupt slowly, then suddenly? We're in the slowly phase, and then at some point we will be in the suddenly phase. It will come on us much faster than we think, and who knows when that's going to be.
I'm just looking at the debt clock here, Jim, and I'm looking at Medicare, Medicaid, almost 1.7 trillion, Social Security, 1.5 trillion, defense, almost a trillion, the debt over a trillion. So, they're not going to cut Medicare or Social Security because the other side, whoever proposes it, they demonize them. So if they do get to that point and cut, what do they cut? It seems to me the only thing they'll probably cut is the military.
Yep.
You can't cut interest on the debt, you got to pay it. And with what, 10,000 baby boomers heading into retirement every single day, Medicare is going to get bigger, Social Security is going to get bigger. I just don't see them touching those two.
Right. And the one thing that you might have had an argument for, and in fact, I was making this argument 5 months ago or so, was we have this big Medicare, Medicaid, Social Security spending. But what is that? That is just delivering resources to certain seniors and people, needing health care or disabilities. Is there a more efficient way we could do it than the wasteful way that the government goes about doing it? Yeah, and that's what Doge was supposed to do. Was the whole idea behind Doge was not we were going to deny people, from access to Medicare or Medicaid. We were just going to deliver it to them in a cheaper way so that we could save the government money. Well, that went up in flames. Doge is effectively done. It didn't really do much of anything. I think we're all the losers for it because we needed to try and make the government more efficient. So we can't even do that at this point, is to acknowledge that the way that Medicare, Medicaid, Social Security delivers those resources to people that qualify for it is very wasteful. It gets full of fraud and abuse. And there is ways that we could give you exactly the thing you're owed from Social Security for less money. And we ran Elon out of town when he even tried to do that. So I just don't see how we're ever going to get to this. As far as defense goes, for the short term, the defense budget is going to go up. But in late June, Trump, and it's a headline now, just in the last hour since we've been talking, Trump is going to attend the NATO conference at the end of June. Just trying to see where it is. He's going to attend the NATO summit at the end of June. The NATO countries have agreed to spend 5% of GDP on defense. They spend about 2% of GDP. That means roughly about $3 trillion that they're going to spend extra on defense over the next decade. The argument is they're going to beef up their defense capabilities so we could back off, let them do it. We don't have to spend the money to do it. The quick, example that I've been giving a lot is we are trying to get the Red Sea open because the Houthis keep firing missiles at ships into the Red Sea. Why are we doing it? Even the New York Times has admitted that the Houthis are too much for any military in Europe to open the Red Sea. Only we can do it right now. So they need to be able to do these kind of things for themselves. And in theory, we could spend less on defense. The problem with that is in theory is many years down the line, assuming that they do it, because the other issue is if you ask the Europeans about should they spend more on defense, they all say yes. But then if you ask the Poles, they'll say, yes, we want a 500,000 man army because we have a border with Russia, and we want the French to give us nuclear weapons so we could stop a first strike invasion against Russia. That's their idea of defense. If you ask the Spaniards, what's your idea of what we should spend on defense? And they agree that they should. They then would say, they literally, the Prime Minister of Spain said, look, we don't worry about the Russians coming over the Pyrenees to invade Spain. So our priorities are cybersecurity, DEI, climate change, and all of that's going to go under the umbrella of defense spending. So Europe's got a big issue that they're going to have to deal with. What do they mean by defense spending? Because every country has a different definition for it. But in general, if they spend more, that means they could take on more responsibilities. We could take on less, and then we would be able to spend less in the future.
And what about some of the legacy systems like carrier battle groups? I mean, I don't know if you saw the Ukrainian attack on Russian air bases with drones. I mean, that was devastating. And that is less.
I think so. The thing that we have to keep in mind about these drones, that and the beeper thing that we saw too with the Israelis blowing up all the beepers, warfare has changed. And what I read about the attack on the 40 odd bombers 2,000 miles or maybe 3,000 miles away from the Ukraine was that the Ukrainian drone attack cost less than $1 million and destroyed nearly $1 billion worth of Russian equipment. That is the problem. And then there was another picture that came up in Newport News, Virginia, which is the East Coast Carrier Battle Group. And they showed the line of about 4 or 5 U.S. aircraft carriers. That's like $10 billion of aircraft carriers, one next to the other, kind of in port, getting, spiffed up before they go back out to sea. And it's like, so what? A couple of $1 million of drones coming over the horizon, and all of a sudden we're out $10 billion worth of battle carriers, in a flash. The definition of how war is being fought is changing in a big way. And so while we're spending, I wonder if we're also spending a lot of money on how to fight the previous war, and we're not really spending enough money on how to fight the future war.
Yeah, I think that's coming. And if we start going with that technology, think of the costs that savings that would have. Because, I'm in San Diego. We have 4 carrier battle groups here. We have a sub base. I mean, I look at all those ships. That is a lot of money to build those things, and then think of all the sailors and the crew that you have out there. The jets, we have Miramar Air Base here. I mean, that's a very expensive. So that could be one means of saving money.
Yeah, and keep in mind too that with this new drone warfare, we're talking about drones that could cost less than $1,000, and they carry like a 30-pound bomb with them. And the argument is you can unleash thousands of them, hundreds of them, if not 1,000 of them. And if we are only 95% effective in trying to shoot all of them down, that means 50 of them get through, and that's enough to wipe out whole aircraft carriers and everything. It can really devastate Air Force bases and cause a lot of damage. And to say that we're going to be able to be 100% effective in knocking down any of them that happen to come at any moment is really, we don't have that technology yet to be that good on it. So the point is we're spending a lot of money, and I see it as we're spending a lot of money to fight the 2015 war, but are we spending enough money to fight the 2030 or 2035 war? And that is really a question, not only for us, but the Europeans want to spend $3 trillion on defense. And what kind of war do they think they're going to be gearing up for as well?
Yeah, we saw that in the Ukraine too, because we would shoot $1 million missile to take out drones. That's not cost effective. You can't win a war that way.
Right. And as a matter of fact, that was also the problem we had with the Red Sea, is we would put a guided missile destroyer in the middle of the Red Sea, and they would send a $30,000 or $40,000 drone. And I mean, these are drones that are probably wingspan of 20 feet wide, carrying a 100-pound bomb, and have like a lawnmower engine to power them. And they would cost, like I said, $30,000 or $40,000. And we would shoot a $10 million missile to shoot them down. The $10 million missile was 100% effective. The problem is they've got more drones than we have $10 million missiles. And they could play that game forever. We cannot play that game forever. So we have to how do you shoot down a $40,000 drone for less than $10,000? Then we could play the game. You could build a $40,000 drone. We could shoot it down for $10,000. We could then play that game with you. That's a whole different way of thinking about how to fight a war that generals have not had to think about cost effectiveness until very, very recently because of technology.
Yeah, I would say the only reason they haven't taken out a carrier battle group is because of our nuclear arsenal. Because if you were to do that, we would respond in a very heavy way. So maybe that's what keeps the peace.
Right. But, if we get into a hot war in Taiwan, or we get into a hot war somewhere else and they feel like it's to their advantage to do it, the expectation is, well, don't be looking in the skies for an ICBM to be coming down out of the atmosphere to land, in San Diego. It's going to be the hum of hundreds of little drones that are going to come over the side. And if enough of them do damage to one of these carriers, it might not sink it, But it could damage it so much it could take weeks and weeks and weeks to fix it. And if you're in the middle of a hot war and you're without that carrier, you're at a disadvantage. And that's what you have to think about in terms of how these wars are going to be fought in the future.
So we've talked about some things that could create some problems, but the natural tendency, I agree with you, the natural tendency, unless we have a major, major shock, is for the economy to grow. So as you look forward, if you were to look at what could go wrong and what could go right, what would those two be?
Well, on the what could go wrong part, I mean, obviously there is the potential for mistakes because one of the things that Trump is doing, and I know the last time I was on with you, we talked about this. The status quo can't hold. We can't keep doing $7 trillion budgets, $2 trillion deficits. We can't keep doing that. So he's trying to do something. He's trying to say, yes, we can't do that. I've got this plan to make Europe pay for defense. I've got this plan to use tariffs to make the US more competitive. The sovereign wealth fund is in that plan to revalue assets and some other things. Okay, that might not go right. Of course, what I've always said was that you could argue that he's doing it wrong, and some are credibly arguing that this is the wrong approach. But what they imply is just stop and go back to the way it was last year. We can't. So if you don't like this radical policy, then we have to do a different radical policy. So we don't know. This is all a leap of faith. We don't know where we're going to go with this. So there is always the possibility that something could go wrong. We've got 3 hot wars going on right now: Gaza, Israel, Pakistan, India, and Russia, Ukraine. At any point, one of those wars could, metastasize into something that is beyond anybody's control to create. So there's lots of those things that could go wrong. And I think where they would all show up immediately, a lot of those problems, again, is I think they would show up in constraints in supply chains and in constraints in supply in general and higher prices and inflation. That's as opposed to, I'm not going to hire anybody, everybody stop doing what they're doing. That would have to be something that would happen here that would have to affect the US. But those other things could affect global supply chains and could affect a lot of those other things. What could go right? That a lot of these things could actually be the necessary medicine that we need to take, in order to get beyond the unsustainability of the debt and the deficit as we go forward. The problem there is, again, I'd like to think that these will go right. I understand it. But like I said, in my mind, if Elon Musk was unable with Doge to rein in waste, fraud, and abuse within the government, I don't know how we do it. I don't know who else can do it. I don't know how else we could do it. If he failed, then it's not fixable, and that is a real concern. But in the meantime, things can go right in that the economy keeps growing, jobs keep getting created, and again, the problem will be higher interest rates and inflation because of all of that wasteful spending. So it's not, what I'm trying to say is it's not a disaster. A disaster is something that people stop hiring, everybody loses their job, and we go destitute. This is more, we're still working, we're still moving forward. It's just that interest rates are high, prices keep going up, and you have this hamster wheel kind of mentality that I'm trying, and I'm on the wheel and I'm running, but I'm not going anywhere, as opposed to not being on the wheel at all, which would be massive unemployment. I don't think we're going to have that right now.
So given all of this and where the markets are, I think you could fairly say that the markets are not cheap, even though we've had a correction. We still have high multiples out there. And the good thing is that what we have now, Jim, that we didn't have 4 or 5 years ago, at least you can get a decent return on cash and in short-term bonds now, which did not exist 5 years ago. So where would you be placing money given what you see here?
So you're right. I think what's changed about these markets is 2 things. You talked about valuation. The forward PE, that's Wall Street's favorite metric. What do they think earnings are going to be next year divided by the price is about 22. That's a fairly high number. It's not the highest we've seen. That was in 21 when we got to 27, but it's up there. It's definitely up there in the higher ends of valuation. What does it mean that the stock market's valued very high? It just means that if you buy it, you're betting on a lot of things going right. And one of those things that you're betting on going right is interest rates don't get in the way of competing with that valuation. So I see that I've referred to it, like I said, the 4, 5, 6 markets. I think over the next couple of years, I'll work backwards. I think stocks are going to return you 6%. 6% is not a disaster. It's going to be above, I think inflation is going to be 3. So it's going to be above inflation. It's going to be a real return. It's just not the 20% that we've all gotten used to. I think bonds, the average bond yield right now, average investment grade yield, all treasuries, all corporates, all mortgages, all agencies that have investment grade ratings is around 5%. So I think you get 6% in stocks. I think you'll get 5% in bonds. And I think cash, the funds rate is at 4.25 to 4.5. Money market rates are slightly above 4. I don't see the Fed cutting rates. I think you're going to get 4 in cash. So it's going to be 4, 5, 6. What's different about this is not the Tina period. There is no alternative of 2019 when you think stocks were going to return you 8 or 10% and money market funds were at 0 and bonds were at 2. But that cash and bonds are a competitive investment to stocks because they will offer you most of the stock market with less risk. And you know who's understood this is investors because interestingly, what is the biggest inflow going this year into ETF flows? It's going into bond funds because people are seeing, well, I can get 70%, 75% of the return of the stock market with much less risk. As I pointed out, last year was not a good year for the bond market, but its return was plus 1%. It's not great, but it's hardly a disaster that it only was up plus 1. Now, I know a lot of people scoff at that because they think, no, the stock market's going to continue to churn out 20% returns. I think if you had a 15 or 16 PE, you could make that case. But when you're already at 22, I think that you can't. By the way, that's what I think some investors are doing is this is why they're all shifting to Europe because the PE ratios in Europe are 10 to 12. And so I think really the European story is not so much the end of American exceptionalism, which is just a bunch of salty Europeans that are mad at Americans, but it's more like in this period of uncertainty and tariffs and wars and everything else, if I buy a 10 to 12 PE market, I only need a couple things to go right and to make money. If I buy a 22 PE market, I need a lot of things to go right to make money. Maybe I should shift into the cheaper market. And I think that that's really what we're seeing driving a lot of the move into the European stocks and everything else. They're cheap. Now, they've been cheap for a reason. They've been terrible underperformers for years. Their economy has lagged, but there's some argument to be made that they're finally going to start to really, stimulate their economy, make efforts to be more competitive. And at a 10 PE, they only need a couple of those things to work. They don't need a lot of them to work to give a return. I think that really explains the rotation more than we think that it's the end of American exceptionalism and the country's going to cease to exist and the dollar's not going to be the reserve currency and everybody's got to put their money in Europe. I don't think that's really what the motivation is for those trades.
And what about, Jim, the shift over to value stocks? Because value stocks tend to do better in a higher interest rate environment than, let's say, your growth stocks.
Same argument. They're cheaper valuations. They need less things to go right than they need for growth stocks to go right. And so therefore, if you go into a value stock, your downside somewhat limited because it's already got a low valuation. It could go lower, but it can't go a lot lower like a growth stock can. And you only need a couple of things to kind of work in your favor, especially if you buy a thematic value stock like a basic material stock or you buy, an industrial or something like that. If we get any kind of success with all of these announcements that Trump has been making, that so-and-so is going to spend hundreds of billions of dollars and here and there, and TSMC is going to be building, fabrication plants in the United States. If you own an industrial company or something like that, that only a couple of those things have to come through and you could make money. Where if you own a growth company and you're paying very high valuations like the Mag 7, you need all of the arguments to kind of happen in order for it to play out correctly. It could happen. It does. But it's just a longer shot play for those companies.
All right. Well, listen, as we conclude, Jim, you have an ETF bond fund. Tell our listeners about that and how they can find out more information about it.
Yeah. So, as an old bond guy who's a macro guy, we started about a year and a half ago, a total return fixed income fund, the 5 and the 4, 5, 6. And so the ticker is WTBN, Wisdom Tree Bianco Nancy. Wisdom Tree is our partner. That's why it's WTBN. BiancoAdvisors.com is the website devoted to our fund and what we're doing with it. BiancoResearch.com is our website. And you can follow me on the socials at Twitter, X, and YouTube at Bianco Research, and under my name, Jim Bianco, on LinkedIn.
All right. Well, listen, I want to thank you for coming on the program. This will be an interesting conversation to have with you in the fall after we get through. Hopefully, the tariff stuff will be subsiding by then, and we'll have a bill that we can look at.
I look forward to having this conversation with you in the fall to see how it